We wait with bated breath till the likes of Alphabet, some of the big heavyweights that really shine a light on how much companies are willing to spend on advertising and drive these sorts of companies forward, Mark.
That's right, Caroline. So, yeah, we're going to get a lot of, I think there are three things we want to all try to, and all the noise we're going to get, and the signal we're going to get this week, let's try to focus on three things. What are these companies telling us about the state of the economy? Is our advertising, retail trends, cloud, enterprise spend trends, are they stabilizing, deteriorating, or improving from where we were in the December quarter? Our best guess is that trends are stabilizing to softening, not recovering yet. The second thing is costs. That's the new sheriff in town, if you will. All of these companies across tech have announced some sort of RIFs, reduction in forces, over the last 3, 6, 9 months. I mean, it's a dramatic change in the mentality of Silicon Valley and of tech broadly. So is there more to come? And what does it actually mean in terms of the bottom line? How successfully are these companies defending their free cash flow and earnings? And then the third thing is, on the positive side, is AI, generative AI. You already teased it out a little bit. I imagine that every tech company is going to mention AI, and somebody should start a counter right now. How many times AI is mentioned in the earnings transcripts over the course of the next couple of weeks? But it's going to be high, but for a reason too. We're at a bit of a tipping point because for a lot of reasons. ChatGPT really brought AI home to most people about what the power is of these models, even though they've been deployed for a while. But the increase in compute capacity really allows kind of a step level increase in the applications, the deployments of AI. So talk about it. We want these companies to talk about how well positioned they are and what their deployment ideas are.
Mark, let's go back to that sheriff in town being cost control. You know, probably the one point of commonality between those names is that they have done layoffs and other cost reduction action and how it shows up. I find Meta to be really interesting in that respect because the top line growth might not be there, but I think we're expecting a sequential improvement in margins, right, because of the actions that they've taken.
I think that's right. I just think of these companies, probably the one that's been most aggressive in taking out costs so far, maybe surprisingly, is Meta. And I think these other companies, I think the market, I think investors want Google to do more with their cost structure. That's probably, and then I think market wants and investors want Amazon to do more too. I don't know about Microsoft. Investors may be comfortable with where they are now. But yeah, I think at the whole, investors kind of want a little bit more. Look, we overbuilt, we overhired because we over-extrapolated from COVID demand trends, but also because we're going into a softening demand environment. You know, households are going to have to tighten their belts, and so will companies. So I think there's going to be an expectation, or at least a hope. This question is whether it's going to be realized that we're going to hear more on the cost front from companies. I think we will from Meta. I'm not sure we will from Google, and I think we will from Amazon, but you know, it's hard to know.
The three big beasts that you analyze, Mark. Amazon also will shine a light, as you said so rightly, on how willing companies are to invest in things like cloud at the moment, AWS, a big profit juggernaut for them, but also for Alphabet, who are hoping to break even in some way on that. What do you expect for how much companies are showing resilience in needing compute power right now?
Well, we're decelerating. I think cloud demand is slowing down. It shot up during part of the COVID crisis. It's been a super hot, high priority level area for enterprise spend for the better part of 5, 6, 7 years. But it's slowed down, and we're going through what's called an optimization cycle, where companies are gonna, you know, when the renewals are coming up, they're demanding bigger discounts or more capacity for the same price. That's clearly happening in the market. That means that these revenue growth rates that Microsoft is going to report with Azure and Google Cloud and AWS are going to report, they're all going to show a slowdown. And the question we have is just how low will it go? And I think we hope that the trough is kind of the June quarter. And we think with Amazon, with AWS, you're going to have like a single-digit % growth in AWS revenue. I mean, that's kind of shocking. If you go back 2 years, nobody would have expected that to happen. But that's probably what's going to happen. And then the question is, how quickly does it base from there and start reaccelerating? We think it will base. We think it will reaccelerate. We just don't really know just how quickly it will. So that's going to be an overhang on the stock.
Mark, if we do get some upside surprise across this kind of pretty broad range of names, where do you think it will be?
I think it's probably going to come on the margin side, Ed. I think it's probably going to come on the cost side because that's what these companies can control. You can't do much about demand trends in a softening macro environment. So I'd be really surprised if we had positive, material upwards revisions on cloud enterprise spend or on retail spend or on advertising spend. I mean, I hope we get them, but as a bull on these stocks, but I don't. I think that's highly unlikely. And the what we should. So I think there'll be positive news on the margins. We should all be just watching out for the chance that if we go into a hard landing in the second half of this year, I don't think that's modeled in. It may be priced in, but I don't think it's modeled into these companies. So that's what we're, like I do worry, like valuation wise, I think there's upside to these stocks because they were so de-risked last year. But estimates wise, I think the first half of the year estimates are fine, a little bit of an upwards bias because of cost cutting. But I just worry about the demand trends. If we have a hard landing, estimates may need to come down in the back half of the year. So I don't know if that's more cautious than you wanted to hear, Ed, but that's kind of how we come out.
And what's interesting about timing this year for this quarter, it used to be that Snap was the bellwether for where we would expect Alphabet and Meta to go, but they're actually behind those two ones in terms of timing this year.
Yeah,
you're right.
Look, we showed the calendar earlier, Mark. It's just the cadence of the week gets bigger and bigger and bigger, but we don't have an early sense, apart from Tesla that's reported, on broadly where we sit in this market.
You're right, Caroline, and you're right. And it's odd the way you set it up, Caroline. You're right that the market took Snap as a bellwether, but come on, it's tiny compared to these other companies, and they haven't executed nearly as well. So they've really been a false indicator most quarters, I would argue. So frankly, I think it's better for the market that they report later because it's just noise that comes out of them. And I don't mean that disrespectfully. I just think that they're less of a read through into the larger players. That's what I really meant to say in a respectful way. Whereas Google is going to give you a really good view on what's happening to overall advertising trends. Google is GDP advertising, so. And I think they're going to talk about trends that are softening, not deteriorating dramatically, but are modestly deteriorating. And I think we should be prepared for that. I think it's going to be a reasonable read through, certainly sizable. It's the single largest advertising data point you can get worldwide. Pay attention to Google.